How to build a $250,000 aggressive ETF portfolio. Hello fellow compounders, welcome back. Today we've got an exciting real case study that answers this question, and I think many of you will find it incredibly useful. For those who are new to the club, I'm Chen. I'm a former hedge fund manager and management consultant. I earned my MBA from the Wharton School, and I am a CFA charter holder. Nowadays, I'm a financially independent full-time investor. On this channel, we explore smart ways to invest and grow your wealth to achieve financial independence. So grab your favorite beverage, sit back, and let's get started. This video is for educational purposes only and should not be considered financial advice. I am not your financial advisor, and you are responsible for your own financial decisions. Case study: crafting a $253,000 diversified growth ETF portfolio. All right, so here's the story. One of our club members, we'll call him George. He's 46 years old, and he reached out to me for some guidance. He's ready to take the plunge into serious investing. He's opening a brokerage account at Charles Schwab and JP Chase. He's got $211,000 to invest, and he's rolling another $42,000 from a previous employer's 401k. This makes his total portfolio $253,000. Yes, a whopping $253,000, $250,000. He wants to be aggressive, but also wants to be smart about diversification. And the best part is that he's got a long-term mindset. He wants to reinvest all his dividends using dividend reinvestment programs, or DRIP, set and forget, and let the money grow. So here are his goals. Here's what we're working with. He wants to balance and diversify across two brokerage accounts, a tax advantage account, which is the Schwab's, and a taxable account, which is the JP Chase. His target is a 9% real return. That means after inflation. It's quite ambitious, but hey, we're always up for a challenge. And he's going to use a set and forget strategy with DRIPs, dividend reinvestment plans. He wants to keep things aggressive but relatively safe using ETFs. So here's the initial allocation. Let's break it down. Charles Schwab account, $178,000, $125,000 to ETFs, $49,000 to a Roth IRA under Charles Schwab also, which is the $42,000 that he rolled over from the previous employer's 401k, plus $7,000 fresh contributions, and a $4,000 health savings account. On the JP side, the brokerage account, he wants to put $75,000, and that's a taxable account. Tax considerations. Here's what gets juicy. Tax efficiency. Roth IRAs are like the superheroes of tax advantage accounts. Contributions are made with after-tax dollars, and future earnings grow tax-free. Let me repeat that. Tax-free. When it's time to take the money out during retirement, Uncle Sam doesn't get a cut, doesn't get a penny, because it's tax-free. In contrast, the Chase taxable account is a little bit different. Realized gains are taxed, dividends also taxed, and that's why we want to be strategic. Keep high growth and dividend paying stocks or assets in the Roth IRAs, and stash the more tax efficient investments in the Chase taxable account. ETF Portfolio Preferences. George is interested in the following ETFs: VOO, Vanguard's S&P 500 ETF; SCHG, Schwab US Large Cap Growth ETF; SCHD, Schwab US Dividend Equity ETF; SCHB, Schwab US Broad Market ETF; VTI, Vanguard's Total Stock Market ETF; QQQM, Invesco's NASDAQ 100 ETF; VXUS, Vanguard's Total International Stock ETF; VNQ, Vanguard's Real Estate ETF; VND, Vanguard's Total Bond Market ETF; VV, Vanguard's Small Cap ETF. He's also wondering about adding REITs and possibly a Vanguard Target Date ETF to his Roth IRA. So let's get into the details. Considerations and recommendations. Balancing the two portfolios. Originally, he was treating the Schwab and Chase accounts separately. Here's how that looked. Charles Schwab account, core growth focus, 30% to VOO, 20% to SCHG, and 10% to QQQM. A power trio, solid exposure to the S&P 500, big growth stocks, and the tech game changers. Dividend yield focus, 20% to SCHD for that sweet, steady income stream. Broad market coverage, 10% to SCHB or VTI for overall US market exposure. International exposure of 5% to VXUS for global flavor, and real estate exposure 5% to VNQ for some of that real estate action. The Chase brokerage account, this is the taxable account. Small cap exposure, 20% to VV because small caps can really pack a punch. Diversified core, 25% to VTI for full US market coverage, dividend income 25% to SCHD for more dividends, and REITs 10% to VNQ because who doesn't like real estate? Oh, and international exposure 10% to VXUS, and bonds had 10% to VND for stability because we all need a little safety net. Updated approach, viewing it as one portfolio. Instead of separating the accounts, let's think about this as one big cohesive portfolio. Here's the new allocation. Core growth focus, 20% to VOO, 20% to SCHG, and 10% to QQQM. We split these growth ETFs between both accounts, but prioritize the Schwab Roth IRA to let those gains grow tax-free. Dividend yield focus, 20% to SCHD. All those juicy dividends should go into the Roth IRA and HSA accounts so they can grow tax-free, compounding without that tax bite. Broad market coverage, 10% to BTI for full market exposure, spread it across both accounts. International exposure, 5% to VXUS. Here's a twist. Keep this in the taxable account. Why? Because you can take advantage of foreign tax credits on the international taxes paid. Boom, tax strategy. Real estate exposure, 5% to VNQ, and keep this in the Roth IRA to avoid the hefty taxes on REIT distributions. Small cap exposure, 5% to VV, put this in the Chase account, the taxable account, for that extra growth potential. Roth IRA investment. For the Roth IRA, I love growth-focused assets like VOO or SCHG. A target date ETF, to answer the question, could also work if you want something that automatically adjusts over time. But let's be honest, it won't be as aggressive as individual ETFs like VOO or SCHG. HSA Allocation. The HSA or Health Savings Account is a hidden gem. Invest in it with a long-term mindset. SCHD for dividends, SCHG for growth. Let this money grow until healthcare expenses come up. It's tax-free going in and tax-free coming out for healthcare. It doesn't get much better than that. Old employer 401k rollover and Roth IRA. The $42,000 from the old 401k should be rolled into the Charles Schwab Roth IRA. A mix of SCHD, VOO, and VND will be a nice blend of growth, dividends, and stability. Performance expectations. A 9% return after inflation sounds like a tall order, right? Well, it's doable if you stick to a diversified, equity-heavy portfolio. But remember, the market has its ups and downs. The suggested allocation is aimed at maximizing growth while also including bonds and dividend ETFs to smooth out the ride. REIT exposure. Real estate is a great hedge against inflation, and VNQ gives you exposure to that sector. Plus, REITs, real estate investment trusts, often have local correlation with other stocks, which means they can be a great diversifier. Additional recommendations. Dollar cost averaging, DCA. Keep investing monthly, even if it's smaller amounts. DCA is your best friend when it comes to avoiding the pitfalls of trying to time the market. Tax efficiency. Put your tax-efficient investments in taxable accounts and your growth-focused and dividend-focused assets in tax-advantaged accounts. Let the compounding magic happen with as little tax drag as possible. Conclusion. By treating these two accounts as one big portfolio, we're maximizing the tax advantages and making sure every dollar is working as hard as it can. This approach balances aggressive growth with safety and smart diversification, perfectly aligning with George's goals. Remember, it's all about core ETFs, dividends, and sector-specific plays like REITs, all strategically placed to help you keep compounding. And remember, if you want a free summary of The Intelligent Investor, you can get it by clicking in the link in the description below. It's a quick and easy guide to all the key concepts that you can keep for your reference. If you have any questions or comments, drop them in the comment section below. Thanks for watching. Remember to always be compounding. See you in the next video. Take care.